Hello. Welcome back to another video. I know. So, hello, sir. Welcome back. I'm going to be going over my trade today. I only traded once today, and I was able to make over 1,000 quid. It was a very nice trade. I am happy with it. But moreover, the profit and loss, I'm actually happy with how I executed it, how I stuck to my plan, how I waited for the plan to come to me instead of chasing a trade. And just as a result of, or a byproduct of trading well, I was able to make money. And that's the key there. For a long time, I used to think and focus purely on the profit and loss. So if I had a green day and I was in profit, I used to think it was a good day, but I might not have stuck with my system, you know? Or if I had a red day, I used to think, right, that was a bad day, but I might have stuck with my system. You see, in trading, it's unlike any other job you'll ever work in your life because you are not paid for your time on the job. You are paid for your opportunity and your opportunities. So here, I'm going to get into how I made over 1,000 quid, and I'm going to tell you my thought process and break down the trade. Now, of course, there's going to be some things that you will not understand, but I promise if you stick through this hopefully short video, I don't want to make it too long, I promise you'll learn something, especially if you have pen and paper out and you're writing anything that you might find interesting. So firstly, I'm going to be starting off on Nasdaq. Now, Nasdaq is the only asset I trade. I might dabble in sometimes the S&P, but predominantly I'm only trading Nasdaq. So we're going to start off in a 15-minute time frame, which is also known as the bellwether time frame. Basically, that means that you just have a nice overview of the last few days on the 15-minute time frame. You get to see what has happened and therefore can predict what is or what could happen next, because us as traders, our job excuse me, got hair stuck in my throat. Our job is to basically predict the future. That's ultimately what we're trying to do here. And it can be done once you understand how the markets move. So here we can see we had a nice move down over the last few days. We then consolidated in this tight range where we didn't move out of it for, let me see how long this is, for about 20 hours here, 20 hours and 15 minutes. We just consolidated in this range up until, look at the time down the bottom, 9:30. Why does price move at 9:30? Think about what happens at 9:30 every single day, Monday to Friday. The market opens. So the market injects volatility into the market, and that's why we have this expansion here. But I'll go through what I was thinking about when the market opened. So as I said, we were consolidating in this range here for 20 hours. Now there's a form, or there's a system that the algorithm runs off of, and smart money also uses it too. It is called accumulation, manipulation, and distribution, AMD. The first part of the The AMD is the A, of course. So we have the accumulation, which occurs here. Now what's happening in here? Smart money is actually buying in here. And we only know this in hindsight because price has gone up. But smart money is buying in this tight range. What do we have here? We don't move out of this range up or down for 20 hours. But then at 8:30, another important time, what happens? Price breaks out of this range and manipulates to the downside. So anyone that's retail minded, i.e. the opposite of smart money, will think, okay, we have been going down here. This is just the next leg down. But this is the false move, otherwise known as the Judas swing. It's manipulation to the downside. It's to fake out any traders who want to go short, and then they get caught out. We then have, after the manipulation, we have distribution. So here's our A, M, D. Now especially after we faked out here and caught anyone who wanted to go short or tried to go short, we caught them out here and then ripped to the upside. I knew, okay, we're going to come back into this range here and we're going to try and attack some of these imbalances here. Okay, and that's exactly what we done. We came up and we attacked some of these imbalances. Now, what is an imbalance? An imbalance is basically a fair value gap. Now, what is a fair value gap? Well, a fair value gap is a 3 candlestick pattern, okay? It consists of 3 candlesticks. So let me get a good example here. Well, let's just start here. So we have 1 here, okay? So let me just label this as 1. This guy here. This guy is 2. Now I know they're a bit off, but you get the point. And this guy is 3. Okay? So a fair value gap is a 3 candlestick pattern. So straight away, you want to go to the first candlestick and go to the bottom, the lowest of the low, which is this wick down here. Okay? And you want to draw that to the top of the 3rd candlestick. Then you want to draw it across. What does that create? It creates a gap. This is a fair value gap, also known as an imbalance. Now, sorry, I'll move that back. We also have another imbalance underneath it here. So instead of counting this one as 1, this one is 2, and this one is 3, we're going to count this one is 3, this one is 2, and this one is 1. So 1, 2, 3. What do? We get our box tool, the first candlestick, the lowest of the low, and then we drag it to the top of the 3rd candlestick. What do we also have here? Another imbalance. And I believe this is the imbalance that price actually attacked, and it did. Look, it came into it here. You see? I wonder why price also came into that specific imbalance. If I was to draw the Fibonacci from the top here, top of the wick, swing high, down to the bottom here, would you look at that? What are we in, Damien? We are in, and I'll let you pause it. If you want to pause it, you can pause it. But we are in a premium here. From the swing high to the swing low, we are in a premium. We were in a discount. We are now in a premium. So that actually makes 100% sense. Price after coming down and after accumulating for a bit, went and then attacked a premium PD array, which is just simply put an imbalance or fair value gap. So price came down, or sorry, came up and took out this imbalance or filled it in. And where did it exactly go? Look how beautiful that is. I went to the exact midpoint of the range. Now, I've often said before that the 50% of the range, just like the midpoint here, 50% of the range, there's something about the algorithm. It really likes referring back to 50% of anything. Now that could be the range, as we have the premium and discount, or it could be this imbalance here where it comes right up to the 50% mark of this range before turning away. So let's get into my trade here. Let's replay back to when I actually entered. So it wasn't until around 12 o'clock New York time, which was about 4 p.m. today, that I actually took my first trade. Now, I got to the charts actually a bit late today. I only sat down for 2:30 p.m. Irish time. So I was only sitting on the charts for about 90 minutes, just watching price before I actually took this trade. Now, I already know my bias, i.e. where I think price is going to go, is long, okay? Because we've had this massive drawdown here, okay? And the algorithm runs off two different models. There's only two models. We have a sell model and a buy model. So if we already had the sell side of the curve, well, for me it was simple that we have the buy side of the curve next, okay? Now where would we be targeting? Well, we could be targeting any premium array, or any premium imbalance, or any premium fair value gap. That all means the same thing. So I was originally targeting this guy up here that I have marked out, which we did eventually hit. So when price expanded at the 9:30 open, I went to my 15-minute bellwether, also known as the bellwether time frame, and I was plotting out to see, okay, do we have any fair value gaps? Yes, we do here. Yes, we do here. What did price, let me just label this fair value gap, and let me label this also fair value gap. FVG, fair value gap. So when price expanded here, let me zoom in for you here so you can see it. When price expanded here, we create a fair value gap here. Here's the first candlestick, here's the second one, and here's the third one. From the top of the first one to the bottom of the third one. It's vice versa if you're looking for longs. This example up here was for shorts. So it's just the opposite way around. So ultimately this creates a gap here, okay? This is where I drew my box. What does price do? Comes into the gap and bounces. Now why does it bounce in this gap? Well, fair value gaps are important because this is where smart money is actually buying. Okay? This is where they buy on uptrends. So we can see price comes into it and bounces. When I seen smart money was still buying after this big expansion move, that was another indicator to me that, okay, we're still looking for longs here. Price then expanded, created another fair value gap, but it also created an order block. Now, of course, you're not going to understand everything here, but it is definitely worth watching to understand how much detail you go into trading. Okay, this is an order block. Now, what is an order block? Simply put, if we're in an uptrend, which we are here, as you can see, price is going up clearly. So we only want to be really seeing green candles, yeah? Anything against that uptrend, i.e. a red candlestick, is an order block. Now this candlestick, because it's red, it opens at the top here, and of course closes below where it opens. Remember, our neutral position is where it opens, and if price goes above that neutral position, like it does here, like it does here, like it does here, the price or the color of the candlestick will then be green. But if it goes below the neutral position, i.e. where it opens, it'll be red. Okay, so we know that this candlestick opened right here at this line that I drew, and I'm going to label that order block because that's also where the order block starts. Now, I told you about the two models, the sell model, which we had here, and the buy model that we're currently in. The best way to think of this is think of it in a kind of a code context. So if this algorithm only runs off certain codes that it is computerized to go off, if we're in an uptrend, price only hits the buys because we are in an uptrend. Okay, but what an order block is, the definition of it is it's a change in the state of delivery, and you can write that down. That's what an order block is. It's a change in the state of delivery. So that means if we were delivering buy side, which we were, that's what we're delivering, but we have a black sheep here, this red candlestick, and price comes down to it, taps it, the algorithm is reminded only after it's tapped that in fact we are in a buy program. So when price comes down to it, like it does so here, we are at the understanding that price is going to bounce off it and continue higher. Why? Because we are in the buying program of the curve, because we've had our sell program. Now we're going to go into our buy program. And if the algorithm comes back and I see that it's holding as support here, which it does, look how beautiful that is. Let me just get rid of this fair value gap here. That's where the opening of this candle is, so that's where you draw the line for your order block. Draw it out in time. Look at the bodies of the candles. Look how well they're respecting it. Yes, we had a wick, but look where they're closing. They're closing above it. That to me showed that we are respecting this order block. We are also in a fair value gap here. And what happened when we were in a fair value gap here? It was bought up. So my thinking is, 1, we're in a fair value gap. 2, we just hit off an order block. And 3, we broke market structure right here. MSS, market structure shift. That's what that stands for. What is this, Damien? You should know what this is here. This 3 candlestick pattern. Pause it, because I'm going to tell you. This is a swing high. When a swing high is broken, especially in a buying program and a selling program, that confirms the market structure shift. So if we were previously in a selling program, this market structure shift says to us that the market is shifting, market structure shift, from a selling program to a buying program. So when I seen price break this high here, bang, it broke above it, create a fair value gap and in an order block, I knew, okay, I'm going to start to look for longs in this area here. So I'm going to go down to a 1 minute time frame. Sorry about that. Going to go down to a 1 minute time frame because I want to try and get the best entry possible. So let's fast forward a bit here. I'm going to actually look at a 2 minute as well. So here we go. My entry happens just now. So with all the boxes ticked, confirming that I'm looking for longs that I named previously there, I am now going to look for a reversal pattern. Okay. So here we can see now bear in mind we're on a 2 minute time frame. So here we can see, what's this up here? Again, you let me know. I'm going to tell you now, so pause it. We have equal highs up here. Look at these boys. All of these highs are relatively equal. Look at this. They're all within the same vicinity. So that means anyone who's going short here, and short here, they're going to be putting their stops or liquidity or stop losses above here. What liquidity? You tell me. Buy side liquidity. Okay. Now you can see how equal these are up here. So that is my target. That's where I'm targeting. I'm not even targeting up here where it does eventually come up. I'm content with taking profits here. But first I'm looking for a reversal pattern. So for a reversal pattern, we want to see a breaker or a mitigation block. Now, of course, you're not going to understand the majority of this video, but it's good to watch and it's good to understand, okay, I need to understand all of this to be able to trade, to make money. So a mitigation block or a breaker block, when we're looking for longs, is a W pattern to where price comes back down before going long. So here's the reversal pattern I was waiting for. And where is it happening? If I go back to the 15 minute time frame, it's happening right at the order block, right in this fair value gap as well. So that's a tick, 2 ticks in my book. Okay. Here's the line for the order block. You can see it's bouncing off that. Okay. We then want to see a reversal pattern, which is a breaker or a mitigation block. And like I said, a mitigation block or a breaker, when you're looking for longs, you want to see W like this in price, but you want to see price come back down into either number 1, a fair value gap, which we have here, because look, 1 candle, 2 candle, 3 candle, the top of the first candle to the bottom of the third, here's our gap. So we have a fair value gap. We also have a mitigation block, which is this green candlestick here. If I draw that across and I label this a mitigation block, and I label you as well a fair value gap, we can see, okay, now we have 2 things lining up here for us. What do we also have? We also have an inversion fair value gap, which is like a normal fair value gap, but it's inverted. It's on the other side of the curve. And I'll show you exactly where I entered. Right here. Let me go back to that candlestick because this is where I entered. When price came down into this fair value gap, that is when I bought. No, I didn't buy there. I bought at the next one. So I bought when price jumped down into this fair value gap. I put my stop loss, SL, underneath this candlestick here. And I was targeting these equal highs up here. So everything in my box has been ticked from our higher time frame order block here, order block, to our shift in market structure, to our fair value gap here, to our equal highs up here as well. So let me get rid of you. Let me get rid of all these to make it a bit clear. I will keep one thing. I will keep the fair value gap here. Actually, no, I'll keep the mitigation block. See, we have all of these things. You have a breaker, you have a fair value gap, you have an inversion fair value gap, you have a mitigation block, you have an order block, and you have a volume imbalance, all to learn before you can start actually trading with real money and making real money. So what happens? Price comes down into the fair value gap, into the inversion fair value gap. Market structure shifted here as well. I forgot to say that actually, because of course this is a swing high. So when a swing high gets invalidated here, when price goes above it, that shows that that's a market structure shift. Okay. So when that happened, my eyes were peaked. I was waiting for price to come back down into this fair value gap to then enter. What happens? I took a little bit of a drawdown here. I was down about 50 quid max before price started to go up. And I then took my profit right here at the equal highs. Because what's above the equal highs? Liquidity. What does our system look for? Number one, liquidity and imbalances. I cashed out, not here, I cashed out here for 1,500 quid. When I entered down here, it took all of 46 minutes to make 1,500 quid. 46 minutes. You tell me another industry or another skill other than the 0.001% of jobs out there that can make that much money for you. And I will quit trading, because there is no job out there like that. Especially when I was chilling, sitting on my hole here, listening to music, you know, and all I had to do was wait patiently for my setup to arrive. Now everything I named in this video is all you need to know to take along. Now I know you're not going to understand it, and that's completely fine. I don't expect you to understand it, but I do want you to understand that this is what it takes to be able to become a profitable trader. And this is what we have to go through. This is what you have to learn. And it's going to take some time. But just know that that's okay. Because even if you spend a year, 2 years, 3 years at this, you will only be young, still in your 20s, mid-20s at latest. But you will have a fucking ATM at your disposal where you can make as much money in as little time as you want. And all you need is a laptop and Wi-Fi. That is all you need. You can travel all over the world. You can live in Dubai. You can live in Miami. You can stay in Ireland. You can move to Kerry. You can move to anywhere you want in the whole world. You can go to Spain, Portugal, anywhere you want with a laptop. And you can make money in minutes. Now this, if I heard this originally, I would have thought this is a get rich quick scheme. And I did originally think that. 3.5 years later, I found out that no, this is not a get rich quick scheme. This is a skill you need to learn. And when you learn it, it's like riding a bike. You will never forget it. It's like driving a car. You will never forget it. So this is my last message to you. Would you prefer to spend your early 20s? We're only talking 1, 2, 3, 4, 5 years max. Learning this skill and struggling. Yes, you will be struggling. There will be times where you'll be depressed. There will be times where you will think to yourself, man, is this really for me? Would you rather be struggling for the first 5 years of your life, but come 25, 26 years old, even 24 years old, onwards, you'll have the best life ever. There will be no struggling. Or would you rather enjoy the next 5, 6, 7, 8 years of your life? And I'm saying enjoy in quotations because you're going to be working a job that you don't like for, quite literally half that time. Because we spend 50, 60 hours, 40, 50, 60 hours a week. Think about that, 40, 50, 60 hours a week working a job that we don't like. And that's most people. So when I say enjoy, don't forget you're going to be working a job that you don't like, making basically shit money. Would you rather enjoy, quote unquote, the first 5, 6, 7, 8 years of your life, but then struggle later on? Or would you rather struggle now and enjoy the fruits of your labor later on? No, I think it's a no-brainer. I've had to miss going out, socializing with friends. And I'm not saying you have to do that. It just depends on how much you want to become successful. Because I know I would rather spend these few years struggling, but ultimately know and understand that if I do put the work in and I'm consistent and disciplined, man, nothing will stop me. It's going to happen. There's zero doubt about it, that if I work, if I'm disciplined and I'm consistent, literally there's nothing to stop you in the world. You will be successful. And that's my mindset. I know, whole hand on heart, I know that in the next year and a half, 2 years, even less, it could be in the next 6 months, that I'm going to finally crack the code with this. I know it seems like I'm doing well now, and don't get me wrong, I am doing well. But I know hand on heart that I'm going to be traveling. I'm going to be in Miami 1 week, Dubai the next week, Ireland the next week. I'm going to go to F1 in Singapore the week after. I'm going to go to the World Cup in 2026 in the US, Mexico and Canada. I'm going to be able to pay off my parents' mortgage. I'm going to have my dream car sitting out here as I look out the window in the office room at the moment. And I know I'm going to put a smile on my family's face, knowing that they don't have to work. That's why I'm doing this. And ultimately, to live the life that I want. And this is all to say that trading is the way. It truly is. But I'll leave it there anyway. If you made it this far, I appreciate you listening. I truly do. Yeah, I went a bit deep there for a few minutes, but man, it is necessary. I need to get that off my chest as much as you needed to hear it. So, yeah, I'm going to leave it there. Hopefully you learned at least one thing. If you learned one thing in this video, I'll take it. And hopefully so will you. But I will leave it there and I will talk to you soon. Thank you for watching and listening to my rant.